So imagine you wake up one morning, right, and you suddenly realize that a single private corporation quietly bought like the water lines running under your street.
Yeah.
And the fiber optic cables powering your internet, the mortgages on the local factories, and I mean, even the underlying deeds to everyone's retirement accounts.
It sounds totally dystopian, honestly.
Right.
Like a sci-fi plot.
Right. But none of this happened in some public town hall. There were no municipal bonds debated in the local paper. The city just has a completely new invisible landlord.
And no one noticed.
Exactly. And today we are taking a deep dive into a document that reads way less like a standard financial report and honestly more like a quiet blueprint for just buying the global economy.
Yeah, we are unpacking the Q2 2026 earnings call of Apollo Global Management, which trades under the ticker APO.
And as always, since we focus on data-forward, actionable takeaways for retail investors, we are going to break down exactly what this means if you hold the stock or if you're just, trying to figure out how your own 401k is going to survive the next 30 years.
It is a profound shift. I mean, we are looking at one of the world's largest alternative asset managers. And decoding this specific call, it reveals exactly how they are just fundamentally rewriting the structural plumbing of global capital.
Yeah.
This isn't just about trading stocks anymore. This is about who funds the actual physical infrastructure of artificial intelligence.
Heavy stuff.
Exactly. The heavy stuff. And how the architecture of everyday retirement accounts is being deliberately positioned for the future.
The scale of what we're covering today is just immense. I mean, we are going to explore a record-breaking $35 billion AI infrastructure deal.
Which is just a crazy number.
Nuts. And this hidden phenomenon that Apollo's management calls the global industrial renaissance. Plus, a bunch of maneuvers designed to permanently blur the lines between public and private money.
Yeah. And for you listening, whether you are managing a massive institutional portfolio, or you're just directing your own 401k, or even if you're just wondering, like, who is actually laying out the capital for the massive server farms powering your ChatGPT prompts, Apollo's strategic moves directly impact your financial reality.
Definitely. So let's just start by looking at the sheer gravity of the headline numbers from this single 90-day period. Because the scale of capital generation here is staggering.
It really is.
In Q2, Apollo generated record fee-related earnings, what they call FRE, of $785 million.
Which is up 25% year over year, by the way.
Right. Massive growth. And on top of that, they posted record spread-related earnings, or SRE, of $877 million.
So when you combine those core drivers, you get an adjusted net income of $1.3 billion.
For a single quarter.
Just one quarter, yeah.
Those numbers demand a deeper look at the actual mechanics of their business model, because it is so easy to get lost in the Wall Street acronyms,
Oh, absolutely. The jargon is a nightmare.
Yep.
But understanding the interplay between that FRE and SRE is really the only way to understand how Apollo actually operates.
Right, because FRE, the fee-related earnings, that's essentially the toll bridge of their operation.
I like that analogy.
Yeah, so Apollo manages massive pools of capital for clients, right? And they charge a highly predictable recurring management fee for basically directing that traffic.
Which is incredibly safe.
Exactly. That $785 million is just the baseline income they generate simply by existing and managing money. It provides this really sticky, stable floor for their earnings.
But the SRE, right, the spread-related earnings coming in at $877 million, that is where the structural complexity really lives.
Because that's driven primarily by their retirement services arm, Athene.
Precisely. So Athene is this massive insurance and retirement services company. And the mechanics of SRE are basically rooted in the fundamental business of annuities.
Okay, break that down for us in plain English.
Sure. So when an individual purchases an annuity for their retirement, they hand over a lump sum of capital to Athene. And in exchange, Athene guarantees them a safe, steady yield, say maybe 4 or 5% annually for the rest of their life.
Sounds like a standard retirement product.
It is. But then Athene takes that lump sum and they just hand it over to Apollo to invest.
Ah. And Apollo's mandate is to take that capital and originate investments that yield something closer to, what, 7 or 8%?
Exactly. And so the spread-related earnings, the SRE, represent the profit captured in that margin. It's just the difference between the 8% Apollo generates out in the market and the 5% Athene promised to the retiree.
And they generated $877 million in profit just on that spread in Q2.
Just on the spread. Which brings us to the core engine of their entire operation, what Apollo's management actually calls their flywheel.
Right, the flywheel, the link between the toll bridge and the spread.
Right, which is a division called Apollo Capital Solutions, or ACS. Yeah, ACS is their internal origination machine. Their sole purpose in life is to find, structure, and create massive corporate loans.
So they aren't just buying bonds on the open market.
No. They're building the deals from scratch. And when ACS originates a complex loan, they collect significant upfront fees, which feeds directly back into that FRE bucket, the toll bridge.
So in Q2 alone, ACS generated a record $277 million in fees just for setting up the deal.
Exactly. So it is this closed-loop ecosystem. ACS creates the supply of massive high-yielding loans. Because they originated the loan themselves, they capture the fee.
Right.
Then they take that newly created asset and feed it directly into Athene's portfolio.
So now Athene has the high-quality yield it needs to offer even more attractive retirement products to the mom-and-pop public.
You got it. And offering more attractive products brings in billions of dollars in new premium from retirees, which gives Apollo an even larger pool of capital that needs to be deployed.
Which just forces ACS to go out and originate even more loans, generating more fees and feeding more yield back to Athene. It is literally a self-sustaining cycle.
The velocity of that flywheel is just, it's hard to overstate. To put a specific number on it, in Q2, Apollo originated $74 billion in loans.
$74 billion.
In 90 days.
I mean, that is the equivalent of originating the entire gross domestic product of a country like Luxembourg or Costa Rica in 3 months.
Right. It brings their first half total for 2026 to nearly $150 billion.
Which is a volume that rivals the largest traditional banks on the planet. But look, the natural question looking at that $74 billion figure is about risk, right?
Sure, you'd think it's incredibly risky.
Yeah. Deploying the GDP of a small nation in 90 days, especially with shifting interest rates and all the macro uncertainty we have right now, it seems inherently dangerous.
Well, you can't just hand out $74 billion in like $1 million chunks.
Right.
The operational friction would just be impossible. You'd need an army of underwriters.
You have to hunt for absolute whales.
Exactly.
But how do they deploy that much capital safely without taking on catastrophic hidden risks?
So Jim Zelter, Apollo's president, he actually addressed the underwriting discipline specifically to counter that exact concern on the call.
What'd he say?
He basically said they're not chasing venture capital style equity returns by taking massive risks. They're operating almost exclusively at the top of the capital structure.
Meaning they act as the senior secured lender.
Right. They're focusing on investment-grade credit quality.
So if a company defaults, Apollo is basically the first in line to take the physical assets.
Exactly. But they take it a step further through the structural mechanics of the loans themselves. They heavily favor amortizing structures.
Okay, explain that, because that's a big deal.
Right. So in a traditional corporate bond, a company might borrow $1 billion, pay interest on it for 10 years, and then they have to pay back the entire $1 billion principal in one massive lump sum at maturity.
Which creates immense refinancing risk. Because what if interest rates are sky high in year 10?
Exactly. The company might just go bankrupt trying to roll that debt over. But Apollo structures their loans so that the principal is paid down continuously over the life of the loan.
Oh, like a normal mortgage.
Basically, yeah. So by the time maturity hits, the risk has been significantly de-risked because a large portion of the capital has already been returned to Apollo.
That makes a lot of sense. But having $74 billion to deploy forces you to operate at an entirely different scale. And management actually noted on the call that this $74 billion figure didn't even include their most significant transaction of the year.
Right, because it hadn't officially closed before the end of the quarter.
Exactly. And that brings us to the Broadcom deal.
Yeah, this is the monster.
Apollo led a $35 billion financing package to support Broadcom's new AI XPV platform. $35 billion. That is the largest single private credit financing ever recorded.
It really is a watershed moment. It totally redefines what private credit is capable of executing.
Because historically, a massive blue chip technology company like Broadcom looking for $35 billion, they would never go to a single private alternative asset manager.
Never.
They would go to a major Wall Street investment bank,
Right.
Goldman, Morgan Stanley, JP Morgan.
Right. And the traditional bank wouldn't even hold that $35 billion on their own balance sheet.
No, they would act as a syndication agent.
Exactly. They would chop that loan into dozens of smaller pieces and spend months conducting roadshows, convincing regional banks, pension funds, and mutual funds around the world to buy a slice of the debt.
But that traditional syndication model is exactly what is fracturing right now.
It is entirely broken for deals this size.
Because when you syndicate a loan of that magnitude, you introduce a massive amount of market vulnerability, which the industry calls syndication risk.
Right. If you are a Wall Street bank trying to sell off pieces of a $35 billion loan and macroeconomic conditions suddenly shift.
Say, like the Federal Reserve unexpectedly signals a rate hike.
Or a geopolitical event spikes market volatility. Suddenly, the regional banks and mutual funds will demand higher yields to take on that debt.
And the pricing gaps out. The terms you promised the corporate borrower, Broadcom in this case, are no longer viable.
And the bank is left holding billions of dollars of toxic debt they can't sell without taking a massive loss. We saw this happen a ton in 2022.
Which is exactly why the traditional banks are retreating. And furthermore, under modern regulatory frameworks like the Basel III Endgame and post-Dodd-Frank capital requirements, large commercial banks are severely penalized for holding highly concentrated capital-intensive corporate loans on their balance sheets.
Right, the regulators force them to hold massive capital buffers, which just destroys their return on equity.
So Broadcom, they look at all that and they say, you know what, let's avoid that entire messy, months-long, highly uncertain syndication process.
Let's bypass the regulatory constraints of the commercial banking sector entirely.
They just walk into Apollo's headquarters, and because of that massive flywheel, because Apollo controls hundreds of billions in captive capital through Athene, Apollo can just write the check. One check.
It's wild. It provides the corporate borrower with speed, scale, and absolute certainty of execution. There is no flex in the pricing. There is no syndication risk.
Right. So if you're holding APO stock, this is your actionable thesis right here. They are stealing the most lucrative business from the traditional banks because they have a structural advantage.
Exactly. You are trading the fragmented complexity of the public debt markets for the streamlined efficiency of a private, single-source capital provider. And as Zelter pointed out, Apollo deliberately designed their entire corporate architecture for these exact moments.
Over the past couple of years, they have originated over $130 billion across 190 of these massive high-grade transactions. So the Broadcom deal isn't some crazy anomaly. It is the culmination of a purpose-built machine.
Right. But the catalyst for a $35 billion check is, of course, the physical reality of artificial intelligence.
Right, the AI build-out.
They tied this Broadcom deal directly to a macroeconomic projection that through the cycle, the global economy is going to require an $8 trillion cumulative investment in AI infrastructure.
8 trillion with a T.
Yes. And the word infrastructure is vital there. The market has been entirely fixated on the software layer of AI, right?
Like the large language models, ChatGPT, the generative apps.
Exactly. But the foundational layer is purely physical. It requires vast tracts of land, massive data centers, advanced cooling systems, and just an unprecedented amount of electrical power generation.
And $8 trillion cannot be funded by venture capital.
No, absolutely not. And as we just discussed, the traditional banking sector is structurally restrained from holding it. This creates an $8 trillion vacuum in global capital formation,
which Apollo is happily filling. And this brings us to the core thesis of Apollo's CEO, Mark Rowan. He delivered a very explicit warning to the market during this call.
Yeah, he was very direct.
He argued that investors are making a fundamental error by assuming this massive capital absorption is strictly an AI phenomenon. He framed it as a much broader global industrial renaissance.
Rowan is looking at the macro constraints of the physical world. For the last 20 years, the global economy was defined by asset-light software company.
Right, you could build $1 billion company in a garage with like a few laptops and an AWS subscription.
Exactly. But today, the most critical economic imperatives are entirely physical, heavy, and capital intensive.
He specifically called out the re-onshoring of the United States industrial base, the massive modernization required in the defense sector, and the sheer scale of the global energy transition.
We are going back to building real, tangible things.
If you want to build a new semiconductor foundry in Arizona to secure the domestic supply chain, that takes 5 to 10 years and tens of billions of dollars before a single chip is even produced.
And that timeline fundamentally breaks traditional financing models.
How?
Well, a commercial bank cannot tie up $10 billion of its balance sheet for 7 years on a construction project without severely damaging its regulatory capital ratios.
Right.
And the public equity markets are notoriously impatient. They demand quarterly earnings growth, not decade-long capital expenditure cycles.
So private credit is basically the only capital pool structurally designed to match long-duration, highly complex physical builds with patient, long-term capital.
Exactly. And the examples they gave on the call to illustrate this industrial renaissance were incredibly diverse. It clearly isn't just about silicon chips.
Yeah, they highlighted a €3 billion joint venture financing for Bayer, the massive life sciences and agriculture conglomerate.
Right. When a legacy corporation like Bayer wants to carve out assets or fund a massive new R&D cycle, they are turning to private credit structures rather than issuing public corporate bonds.
Because the structural flexibility of private credit allows Apollo to custom-build financing solutions that public bond markets simply cannot accommodate.
But I'd argue the most illustrative example of this physical infrastructure thesis was their $5.3 billion financing for Williams Company.
Oh, this deal is fascinating. It connects the digital abstraction of AI directly to the dirty reality of the energy grid.
Yes, it really does.
So this was a financing package specifically for what they call behind-the-meter gas-fired power projects.
To understand the significance of that, you have to look at the power constraints facing companies like Meta and Microsoft right now.
Right.
An AI data center requires massive, uninterrupted baseload power running 24 hours a day, 7 days a week.
And solar and wind energy are inherently intermittent. The sun sets, the wind stops blowing.
Exactly. You cannot power a gigawatt AI training cluster on intermittent power without massive battery storage, which just isn't economically viable at that scale yet.
And even if you wanted to pull that baseload power from the traditional electrical grid, the grid is completely tapped out.
Oh, totally. The interconnect queues, the waiting list, to legally connect a massive new facility to the regional power transmission lines can be 5 to 10 years long in key data center markets, like Northern Virginia.
And technology companies simply cannot wait a decade to turn their servers on. The AI race will be over by then.
Right, which necessitates the behind-the-meter solution.
So instead of waiting for the public grid, a midstream energy company like Williams will build a localized natural gas pipeline directly to the site of the data center.
They build a dedicated gas-fired power turbine physically on the premises.
So the power generation happens behind the utility meter, bypassing the public grid entirely.
But building a dedicated pipeline and a private power plant requires billions of dollars of upfront capital expenditure.
And this is where Apollo steps in. Apollo funds that massive $5.3 billion build-out.
And they can underwrite that risk safely because Meta or Microsoft will sign a 20-year ironclad power purchase agreement guaranteeing they will buy all the electricity that plant produces.
So the cash flow is secured by the credit rating of $1 trillion tech monopoly. But the actual asset being built is a natural gas pipeline and a turbine.
It is the ultimate picks and shovels play.
Or pipelines and turbines play. You don't take the venture risk on which AI software company is going to win. You just take the secured debt position on the localized power plant that all of them require to function.
It's brilliant.
It is. But this approach to financing the physical world extends far beyond industrial energy and data centers. They highlighted their aggressive move into the sports ecosystem.
Yeah, this part of the call caught me off guard at first.
They detailed investments in Wrexham, AFC, Atletico Madrid, and even their role in structuring the parent company for Major League Pickleball.
Right. On the surface, professional pickleball and European football seem completely disconnected from semiconductor plants and gas turbines.
But financially, the structural characteristics are identical. The modern sports ecosystem is a massive, capital-hungry industry. Teams need hundreds of millions of dollars to build new stadiums, modernize their training facilities, and professionalize their digital broadcasting infrastructure. And the revenue streams in professional sports, the long-term broadcasting rights contracts, the multi-year corporate sponsorships, the guaranteed ticketing revenues, they are incredibly predictable and stable.
Exactly. Apollo isn't buying these teams to manage the rosters or pick the players.
They aren't trying to be Jerry Jones.
Right. They are applying their massive balance sheet to institutionalize fragmented physical businesses. They take the highly predictable IP and broadcasting revenues, structure them as collateral, and provide the long-term debt needed to build the physical stadiums and media infrastructure.
It is the exact same underwriting philosophy applied to a completely different asset class.
And Mark Rowan used this broad expansion into the physical economy to make a rather chilling observation about the state of the public stock market.
Yes, he noted that just 10 individual stocks currently make up nearly 50% of the entire market capitalization of the S&P 500.
Which is an era of unprecedented public market concentration.
It fundamentally challenges the core tenet of modern portfolio theory. For generations, mom-and-pop retail investors have been taught that buying a broad public index fund provides inherent diversification.
But if half of your index fund is tied to the performance of just 10 technology companies, you are not diversified.
No, you are taking a massive, highly correlated bet on a single sector.
If the regulatory environment for big tech changes, or if the AI monetization cycle takes longer than expected, those 10 stocks will draw down simultaneously.
And when things go poorly for the top 10, they drag the entire index down with them. The illusion of diversification evaporates.
Rowan's argument is that true economic diversification no longer exists in the public equity markets because the number of publicly traded companies has plummeted from over 8,000 in the late 1990s to roughly 3,800 today.
Right. The real diverse economy, the Bayer joint ventures, the localized power plants, the sports media rights, the mid-market manufacturing facilities, it is all being funded in the private markets.
But if Apollo and the private credit industry are absorbing the financing of the entire physical rebuilding of the global economy, the capital requirements are essentially infinite.
Exactly. The Athene flywheel is massive, but it has limits. This requires a structural shift in where the capital is sourced. And on the call, Rowan laid out a master plan to fundamentally alter who is allowed to invest in private markets.
Shifting the industry from a single buyer base to 6 distinct buyers.
This is perhaps the most consequential structural change discussed on the call.
Absolutely. Because historically, private equity and private credit operated inside a very exclusive walled garden.
Right, the velvet rope.
Yeah, the entire industry was built to serve one specific category of buyer, the alternative allocation bucket of massive institutional investors. We're talking about state pension funds, sovereign wealth funds, and multi-billion-dollar university endowments.
That was the only capital pool that could handle the strict lockup periods and massive minimum investment sizes.
But the new strategy aggressively expands that horizon. Rowan detailed 6 specific buyers they are now targeting.
First is that legacy institutional alternative bucket.
Second, they are going after high net worth individuals and family offices.
Third, the broader insurance industry beyond just Athene.
Fourth, they are targeting the massive core fixed income and investment grade debt allocations of their institutional clients, money that historically only bought safe government bonds or public corporate debt.
Fifth, they are selling to traditional asset managers. And sixth, the holy grail of capital accumulation. The 401k and defined contribution retirement plans of everyday workers.
But accessing the 401k market and the retail investor fundamentally changes the engineering requirements of the asset class.
How so?
Well, if you are selling a private credit fund to a sovereign wealth fund, they are perfectly comfortable locking their capital away for 10 years in a deeply illiquid structure.
Right, they don't need the cash tomorrow.
But you cannot put a 10-year locked-up opaque asset into a standard 401k plan. Retail investors and daily traded asset managers require liquidity.
They need to know what the asset is worth on any given Tuesday.
Exactly. And they need the ability to sell it if they want to buy a house or reallocate their portfolio.
Rowan summarized this constraint perfectly. He said the industry have to, quote, meet clients where they are, not where we wish they would be.
And meeting them where they are means forcing historically bespoke, illiquid private credit to behave exactly like public stocks and public bonds.
It requires daily pricing, standardized data, and seamless tradability.
Which is a monumental operational and technological challenge. I mean, a private corporate loan is not a standardized instrument.
No, it's usually a highly bespoke, legally complex agreement, often running hundreds of pages, with customized covenants, amortization schedules, and collateral structures.
Trying to price and trade that daily requires digitizing and standardizing an intentionally unstandardized market.
But they announced specific structural leaps on this call that prove they are actually doing it.
Right. First, they launched Estimated Daily Value, or EDV.
They announced that EDV went live on July 1st for all of their fixed income investment grade products. And they're pushing aggressively to have daily pricing across all their credit assets by October 1st.
Pricing the asset daily is the first hurdle, but a price is useless if the asset cannot be efficiently traded between counterparties.
Because the settlement process for a private loan has historically been an agonizing manual process involving lawyers and physical document reviews, taking weeks to clear.
Which is why the joint venture with ICE, the Intercontinental Exchange, is so critical.
ICE operates some of the largest digital financial exchanges in the world, including the New York Stock Exchange, right?
Exactly. And Apollo and ICE have partnered to create over 2,000 what they call ICE IDs for private credit instruments.
Okay, to understand the impact of an ICE ID, you have to look at how public markets operate. Every public stock or bond in North America is assigned a CSIP rate.
Right, a standardized 9-character alphanumeric code.
So when a mutual fund wants to buy 1,000 shares of Apple or $10 million of a public Ford corporate bond, they don't read the underlying legal documents.
No, the clearinghouse simply matches the CUSIPs, and the trade settles digitally in a matter of seconds. The CUSIP provides the standardized data taxonomy that allows algorithmic trading and massive liquidity to exist.
And an ICEID essentially acts as a CSIP for the private market.
Exactly. Apollo is taking that massive stack of bespoke legal documents that makes up a private loan, extracting the critical data fields, the yield, the duration, the collateral type, the amortization schedule, and attaching them to a standardized digital identifier.
They are converting a custom-built legal contract into a highly liquid, tradable security.
And the results of this standardization are already materializing. Apollo noted on the call that their market-making volume in these private assets has doubled, with over $30 billion traded.
Wow.
When you provide the digital plumbing and the standardized identifiers, institutional demand for liquidity immediately follows.
They even took this concept of public-like liquidity further by highlighting their successful partnership with State Street to create an ETF, trading under the ticker symbol PRIV.
ORV.
Right. This exchange-traded fund blends public debt with Apollo's private credit assets. It recently crossed the billion-dollar threshold, and crucially, it offers daily creation and redemption exactly like a standard S&P 500 ETF.
You can literally buy and sell it on your brokerage app.
Which is crazy for private credit. The PRIV ETF is the ultimate proof of concept. It demonstrates that the financial engineering now exists to take the complex, high-yielding assets originated in the private markets and wrap them in the transparent, highly liquid, daily traded architecture of the public markets.
It bridges the gap between the complex origination machine and the retail 401k investor.
But hold on, we need to examine the underlying logic here.
Okay.
If you are taking a private loan and putting it into a daily traded ETF wrapper, you are fundamentally altering the nature of the asset. In traditional financial theory, the entire reason private equity and private credit generate higher returns than public markets is the illiquidity premium.
Right.
Investors demand a higher yield precisely because their cash is locked up and they cannot sell the asset in a panic. So if you attach an ICE ID to it, price it daily, and let retail investors trade it in an ETF, don't you instantly destroy the illiquidity premium?
That's a great question.
Aren't they just recreating the public bond market complete with daily volatility and panic selling and effectively erasing the very mechanism that makes Apollo so profitable?
That is the central tension of this entire democratization strategy. And it represents a profound divergence in how Apollo views the source of their excess returns compared to traditional academic finance.
Okay, unpack that.
The academic view is exactly what you described. The premium exists solely to compensate for the lockup period.
Yeah.
But Mark Rowland and Apollo's management argue that the premium has evolved. They believe the excess yield isn't just an illiquidity premium, it is an origination premium.
Meaning they get paid more because they're doing the heavy lifting of actually building the deal.
Exactly. Apollo captures that spread because they have this specialized infrastructure to go out, negotiate with Williams Company, structure the complex covenants for a behind-the-meter gas plant, and underwrite the specific operational risks.
They are cutting out the syndicate banks, the rating agencies, and all that public market friction.
Yes. Apollo believes that as long as they control that primary origination engine, they can retain the higher yield, even if they strip away the illiquidity discount on the secondary trading side.
They are essentially isolating the value of their labor. They originate the highly complex bespoke loan to the pickleball league or the defense contractor, which generates the massive yield, and then they use technology to wrap that yield in a liquid ETF for the masses.
And if that hypothesis holds true, and they can offer private market yields with public market liquidity, the sheer volume of capital that will rotate out of traditional public bonds and into Apollo's ecosystem is virtually limitless.
Which leads directly into the battleground where this new capital is most concentrated.
The retirement market.
Exactly. The democratization of private credit is ultimately aimed at capturing the largest demographic shift in modern financial history, the retirement of the baby boomer generation.
Millions of individuals are transitioning from the wealth accumulation phase of their careers into the income decumulation phase of retirement.
They desperately need safe, guaranteed yield to survive.
And that brings us back to the spread engine Athene.
The growth metrics they reported for Athene in the first half of the year demonstrate exactly how fierce the demand for retirement income has become.
Athene reached $414 billion in gross invested assets.
$414 billion. And in just the first 6 months of the year, they took in $42 billion in gross inflows. The scale of capital moving into their annuity products is accelerating rapidly.
Athene has basically established itself as the dominant apex predator in the retirement services space.
But the sheer profitability of that Athena-Apollo flywheel has attracted an unprecedented level of competition. Wall Street is not blind to the margins Apollo is generating.
No, of course not. During the call, management specifically noted that there are currently 36 new asset management entrants actively trying to penetrate the retail annuity market.
36. You have 36 massive financial institutions trying to clone the Athene playbook from scratch.
Right. Now, if you are an Apollo shareholder, hearing that 36 heavily capitalized competitors are storming your most profitable market should be terrifying.
But Apollo's management was incredibly dismissive of the threat.
They articulated a devastating critique of why these newcomers are fundamentally miscalculating what it takes to survive in this specific industry.
Their critique centers on the difference between having capital and having infrastructure.
Exactly. These new entrants are largely traditional asset managers. They are very good at raising billions of dollars from clients.
But raising the money is only half the equation in the annuity business.
The critical failure point for these competitors is that they lack a mature origination machine. They do not have an internal Apollo Capital Solutions that can reliably generate $74 billion of high-grade, structurally secure private credit every quarter.
So these new competitors raise billions of dollars from retirees by promising them a 5% guaranteed yield, but when they look around for a safe place to invest that cash to earn 7%, they realize they don't have the internal mechanism to originate the loans.
Right. They are forced to buy assets in the highly competitive, lower-yielding syndicated public markets, which compresses their spread and ruins their margins.
Exactly. And the deficiency extends beyond just origination. Running a massive life insurance and annuity business requires incredibly sophisticated liability structures.
You are not just managing an investment portfolio, you are managing complex actuarial science.
You have to model mortality rates, longevity risk, lapse rates, and policyholder behavior across decades.
Plus, you have to navigate a labyrinth of state-by-state regulatory compliance and maintain a massive, highly specialized back-office operational infrastructure.
This operational reality heavily informs Apollo's broader corporate strategy, specifically regarding mergers and acquisitions.
Right, M&A.
An analyst on the earnings call asked a very logical question. Given Apollo's massive cash flow and the fragmented nature of the market, are they planning to acquire other asset managers to accelerate their growth and buy out the competition?
And Mark Rowan's response was incredibly blunt.
He explicitly stated that Apollo vastly prefers to build adjacent businesses organically, like constructing their sports financing platform or their market-making operations from the ground up rather than acquiring competitors.
He specifically cited the, quote, brain damage associated with people businesses.
Brain damage.
Yeah, that phrase perfectly encapsulates the historical nightmare of M&A in the financial sector.
Asset management is fundamentally different from industrial manufacturing. If you buy a semiconductor company, you acquire patents, physical fabrication plants, and proprietary supply chains.
But if you buy an asset management firm, your core assets are the portfolio managers and the client relationships. And those assets go down the elevator and leave the building every night.
Exactly. When you acquire a competitor, you are essentially buying a clash of cultures. You are buying entrenched egos, conflicting compensation structures, and a legacy technology stack that never perfectly integrates with your own.
It is like deciding you need more space. So instead of hiring an architect to build a custom state-of-the-art wing on your own house, you buy your neighbor's house and try to smash the two foundations together.
You inherit their leaking roof, their faulty plumbing, and a completely different architectural style. Apollo has determined that the friction of integration simply isn't worth the accelerated growth timeline.
And because Apollo refuses to buy them, and because these 36 new competitors are discovering how painfully slow and expensive it is to build a legitimate origination and actuarial infrastructure organically, the newer entrants are being forced to find shortcuts to remain competitive.
Right. They have to find a way to offer high yields to retirees without having the specialized origination machine to actually generate those yields safely.
And the word shortcut is incredibly dangerous when applied to the guaranteed life savings of retirees.
Absolutely. And this dynamic is what drove the most legally dense, yet arguably the most critical segment of the entire earnings call. Apollo is actively engaged in a massive regulatory lobbying effort to shut those competitors' shortcuts down.
We're talking about their aggressive campaign against offshore regulatory arbitrage, specifically targeting domiciles like the Cayman Islands.
To understand what is happening here, you have to understand how state insurance regulation works in the United States.
Right. Domestic life insurance companies are regulated by state bodies, coordinated through the NAIC, the National Association of Insurance Commissioners.
And the NAIC sets incredibly strict rules regarding statutory capital. If an insurer in Iowa or New York writes $1 billion in annuities, the NAIC dictates exactly how much safe, liquid capital they must hold in reserve against those future liabilities.
Those reserve requirements are calculated using highly conservative actuarial mortality tables and stress-tested asset assumptions.
So those strict capital buffers protect the retiree, but they also severely limit how much profit the insurance company can make because billions of dollars are trapped in low-yielding reserve accounts rather than being aggressively invested.
Correct. So to circumvent these strict domestic rules, many of the newer, smaller entrants in the annuity space utilize offshore reinsurance structures.
They set up entities in jurisdictions like the Cayman Islands or Bermuda.
Right. And the regulatory bodies in those offshore domiciles often allow companies to use much more aggressive actuarial assumptions.
They might allow the insurer to assume higher future returns on their investments or use different mortality tables that assume policyholders won't live as long.
By changing the mathematical assumptions, the offshore regulator allows the company to hold significantly less capital in reserve today.
Exactly. It frees up massive amounts of cash.
And the competitor takes that freed up capital and invests it in higher yielding, inherently riskier assets.
This artificial yield boost allows them to go to the retail market and offer a 7% annuity when a strictly regulated domestic player like Apollo's Athene can only safely offer 6%.
They are winning market share, not by being better investors, but by exploiting regulatory geographic loopholes to take on hidden leverage.
And that is regulatory arbitrage. Now, usually, major Wall Street firms spend millions of dollars lobbying Washington to deregulate their industry.
Sure, we usually want less red tape.
But on this call, Apollo detailed an aggressive push, working directly alongside the NAIC to end this offshore arbitrage. They are actively demanding stricter, more uniform government regulation.
It seems completely counterintuitive, right? Why is a titan of global finance begging the regulators to impose tougher rules on their own industry?
Because the concept of trust is an existential requirement for the entire life insurance ecosystem.
Right.
When a retiree hands over their 401k rollover to buy an annuity, they're buying a highly emotional product, the psychological security of guaranteed lifetime income.
If one of these smaller competitors uses Cayman Islands arbitrage to artificially boost yields, takes on massive risk in the underlying portfolio, and eventually blows up when a recession hits.
The resulting panic doesn't stay confined to the Cayman Islands.
Exactly.
The mainstream headline won't read, "Complex offshore reinsurance loophole fails." The headline will read, "Retirees lose life savings in annuity collapse."
It would instantly vaporize consumer confidence across the entire sector, severely damaging Apollo's pristine Athene franchise by association.
But the risk to Apollo isn't just reputational, it is intensely financial.
Right, because of the state guarantee associations.
It functions similarly to the FDIC for banks, but it is funded by the industry itself. If a reckless competitor goes bankrupt and cannot pay its policyholders, the state regulators mandate that the healthy, surviving insurance companies must pitch in capital to make good on those broken promises.
Mark Rowan addressed this dynamic with absolute precision. He stated that Apollo is, quote, tired of making good on guarantees for visible risk.
They can see the systemic fragility being built up in these offshore domiciles, and they know that because of their massive scale and fortress balance sheet, Apollo will literally be handed the bill when those fragile competitors inevitably collapse.
Therefore, Apollo is leveraging its massive influence to force a level playing field. Their lobbying mandate to the NAIC is simple: equal capital for equal risk.
They are demanding that whether a liability is domiciled in New York, Iowa, or the Cayman Islands, the underlying capital requirements must be identical.
Rowan's influence here is massive. He noted that he was the invited guest at the NAIC conference in Washington, D.C., effectively co-authoring the regulatory roadmap alongside the chief regulators.
They are pairing this aggressive regulatory push with a distinct internal financial strategy. Rowan emphasized that Apollo is pursuing a pristine AA credit rating for their operating entities.
He admitted they don't strictly need a AA rating to run their business day to day. The purpose of securing that elite rating is purely comparative.
It is designed to make the distinction between Apollo's fortress-like domestic balance sheet and the highly leveraged offshore structures of their competitors completely unmistakable to institutional buyers and ratings agencies.
It is a strategy of absolute separation. By aggressively pushing the NAIC to close the offshore loopholes, Apollo is weaponizing regulation as a competitive moat.
Actionable takeaway here. If the NAIC enforces equal capital for equal risk globally, the compliance costs and capital requirements for doing business in the annuity space will skyrocket overnight.
The 36 new entrants relying on those offshore shortcuts will suddenly find their margins completely crushed.
They won't have the capital to meet the new domestic standards, and they don't have the internal origination machines to generate yield organically.
They will be squeezed out of the market entirely. And Apollo, already operating with a domestic fortress balance sheet, will simply sweep up the abandoned market share.
It is a ruthless, highly sophisticated application of regulatory capture, framed entirely as consumer protection.
It secures their dominance in the present. But what became apparent toward the end of the earnings call is that Apollo is acutely aware of the dangers of institutional stagnation.
Dominating the current regulatory landscape isn't enough. They're actively allocating capital to future-proof their operations against geographic and technological disruption.
The forward-looking initiatives they buried at the end of the Q&A session were highly revealing.
Yeah, like the opening of a massive new corporate office in Austin, Texas. Historically, elite Wall Street alternative asset managers do not leave the New York-Connecticut corridor unless it is to open a satellite office for tax purposes in Florida.
Right. But Mark Rowan explicitly stated this move to Austin has absolutely nothing to do with cheaper real estate or corporate tax optimization.
The Austin strategy is a deliberate attempt to engineer a new corporate culture.
Rowan's commentary on the current state of the financial workforce was a scathing indictment of the legacy Wall Street establishment. He argued that the vast majority of the industry's talent pool is deeply entrenched in archaic methodologies and legacy spreadsheet architecture.
He used a phrase that perfectly captures the inertia of legacy finance. He said Apollo needs to separate itself from the 95% of firms in the industry who simply want the world to stop changing until the principals can retire.
It is a phenomenal observation. I mean, the leadership of many traditional asset managers made their fortunes in the old macro environment of zero interest rates and public syndication.
They have zero incentive to rebuild the complex digital plumbing required for daily traded private credit or AI infrastructure financing.
Apollo sees Austin as a hub of fundamentally different intellectual capital. They aren't looking for traditional investment bankers in bespoke suits.
They need software engineers, data scientists, and systems architects who can build the digital infrastructure necessary to process $74 billion of origination volume and attach daily pricing to bespoke credit instruments.
They're moving to a tech hub to hire a tech workforce to solve financial plumbing problems.
This expansionist mindset applies globally as well. They detailed the integration of PIC, a major player in the United Kingdom, with their broader European platform, Athora.
The mechanics of the European market offer a massive, structurally advantageous opportunity for Apollo's specific skill set.
The demographic pressures in Europe are even more acute than in the United States. The European population is aging rapidly, and the continent is heavily burdened by legacy corporate defined benefit pension plans.
These massive corporate pensions are increasingly underfunded and volatile, creating massive balance sheet risk for European industrial companies.
Which creates a massive market for pension risk transfer, or PRT.
Right. A European corporation will essentially pay Apollo's Athora platform to take over the entire pension obligation, removing the liability from the corporate balance sheet.
And because the European banking sector is even more highly regulated and capital constrained than the U.S. sector, the structural void for private credit origination is massive.
By integrating PIC, Apollo is building the pan-European scale necessary to originate high-yielding European assets and manage massive pools of European pension liabilities simultaneously.
They explicitly noted they are targeting mid-teens returns in this space, exporting their American flywheel model into an aging European demographic desperate for yield.
The final glimpse into their future-proofing strategy came in response to an analyst question regarding the tokenization of funds and the integration of blockchain technology.
Right. Tokenization is currently the loudest buzzword in fintech. The idea of taking a private equity fund or a private credit portfolio, putting it on a distributed ledger, and allowing investors to trade digital tokens representing fractional ownership, theoretically bypassing traditional clearinghouses entirely.
Given Apollo's push into daily liquidity and ICIDs, you might expect them to aggressively champion tokenization.
But Jim Zelter offered a surprisingly pragmatic response. He stated that Apollo is, quote, working in the lab on tokenization, but he openly admitted it is far too early to call the future of tokenized funds a certainty.
It is a critical distinction between technological hype and operational reality. Zelter and the management team acknowledged the theoretical brilliance of distributed ledger technology.
The legacy back-office systems that clear and settle trades in traditional finance are painfully slow, prone to manual errors, and incredibly expensive to maintain.
A highly secure, instant settlement blockchain could hypothetically revolutionize that plumbing.
But you cannot run a trillion-dollar asset manager on hypothetical plumbing.
Exactly. They are actively experimenting with tokenization in isolated, controlled environments.
Yeah.
But they are not betting the core functionality of their massive origination machine on an unproven technology that lacks comprehensive regulatory frameworks.
It demonstrates a healthy paranoia. They are terrified of being left behind by technological shifts, which is why they are building in Austin and experimenting with blockchain, but they refuse to compromise the immense profitability of their current proven architecture just to chase a trend.
As Andy Grove famously said, only the paranoid survive. The fact that a firm generating $1.3 billion in adjusted net income in a single quarter is actively worried about institutional stagnation and legacy culture is precisely why they are succeeding at such a massive scale.
The sheer breadth of the strategic architecture we have covered today is almost difficult to process. We started by looking at a single 90-day reporting period, and it expanded into a masterclass on global economic restructuring.
Right, it really did.
We unpacked a record-breaking $35 billion private credit package to build the physical data centers and power grids required for artificial intelligence.
We analyzed the funding of natural gas turbines and professional sports leagues as part of a much broader global industrial renaissance.
We broke down the digital mechanics of attaching SUSIP-like ICE-EIDs to bespoke corporate loans to force private credit into daily traded ETF wrappers.
And we navigated the granular, bare-knuckle regulatory lobbying efforts designed to crush offshore competitors in the Cayman Islands and protect the integrity of the retail annuity market.
Synthesizing all of those disparate data points reveals the true nature of Apollo's ambition. They are no longer simply a private equity firm buying out distressed companies.
They have evolved into a fundamental infrastructural pillar of the global economy. As traditional commercial banking retreats under the weight of regulatory capital requirements, and as public equity markets become increasingly distorted by the massive concentration of a few technology monopolies, Apollo has built a self-sustaining, closed-loop machine capable of financing the heavy, physical reality of the future.
Which brings me to a final, lingering thought I want you to carry forward as you look at your own portfolio and the broader financial headlines. We are living through a period of immense structural contradiction. On one hand, Apollo and the private credit industry are aggressively adopting the historical characteristics of the public markets. They are engineering daily pricing, launching exchange-traded funds, establishing standardized identifiers, and generating tens of billions of dollars in market-making trading volume.
They are bringing transparency and liquidity to the historically dark, opaque world of private capital.
Exactly. And simultaneously, the public stock market is adopting the historical characteristics of highly concentrated, risky alternative investments.
If you buy a broad public index fund today, you are essentially placing a massive, highly correlated venture capital style bet on the future earnings multiples of just 10 massive technology conglomerates.
The foundational characteristics of the two markets are actively crossing each other. We may very well be witnessing the early stages of the ultimate financial inversion.
It's a wild thought.
Think about the trajectory we are on. Over the next decade, the private market, which historically required 10-year lockups, massive minimum investments, and opaque reporting, might actually become the deeply diversified, highly stable, legally standardized, and highly liquid backbone of the global economy.
It'll be the venue where the actual physical world, the power plants, the defense contractors, the industrial supply chains gets funded and traded.
While the public stock market, which was designed to be the safe, diverse, heavily regulated harbor for mom-and-pop retail investors, increasingly becomes a hypervolatile, heavily concentrated niche arena dominated by a handful of monopolistic tech giants, a total inversion of modern financial theory.
It really makes you rethink everything about asset allocation.
So as you project forward, ask yourself this. When you log in to check the balance of your 401k or your retirement annuity in the year 2030, will you even know or care what percentage of your wealth is technically defined as public versus private anymore?
Or will that distinction have been entirely erased by the sheer gravitational pull of firms like Apollo?
We began this deep dive by noting how the civic engineering of the past, the bridges and the power grids, used to be debated in the public square, financed by public municipal bonds with blueprints everyone could see. But as Apollo's massive, relentless machinery proves, the new blueprints for the global economy are being drawn up behind closed doors, funded by private institutional capital, and delivered directly into the foundation of your retirement account.
The architecture of the city has fundamentally changed, and the new invisible landlord has already collected the rent.
Thanks for joining us on this deep dive.